Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 114th VideoCast and 104th podcast for the week ending December 23rd, 2021, the eve before Christmas Eve. Merry Christmas to all who celebrate. And we're going to get right down to it. I know people have busy weekends ahead, so we'll try to keep this one short but packed with good information. First, I'd like to thank Ellie Terrett and Liz Clayman for having me on the Clayman Countdown on Tuesday of this week. We're going to go into that content a little later in the podcast. But I wanted to share a few quick holiday photos with you for those of you who've been with me for a couple of years and gotten to know each other. This is us with our girls and Santa, and we got Mrs. Claus. We took that this weekend, which was great. This was gingerbread house making a couple of weeks ago. This is my wife and I at a friend's house. We lost the ugly sweater contest at our friend's house, but we did win the couple sweater at our club. So we were happy to get that contest won. And then this is something new. I played paddle for the first time last night. And if you've never played, you should try it. If you like being out in 25-degree weather at night and sweating in spite of that and just having a good time, it's basically like ping pong, but you're standing on the ping pong table or mini tennis, whatever you prefer. So that was a lot of fun. And moving on to the content here. So industrial stocks is an area that we've been focused on for 2022, and we're going to talk about that a little bit later in the podcast. But the core reason is if you look at sector earnings, so the S&P 500 has trickled up again. Estimates for 2022 are $223.48. Not quite at the 230 yet, but I think within the first couple of weeks of earnings season in January, we should see our $230 target hit. Which would be put us in that low double digits to high single digit range expectations for 2022. And then Tom Lee, one of my favorite sell side analysts, came out 3 reasons why the S&P is set to rise at least 11% in 2022. He's always very optimistic, but I could certainly see that happening. And he's pointing to inflation is transitory. He does pointed to the surge in prices in used car, new vehicles, and home furnishing. Those are going to all normalize as the supply chain normalizes. And if you look under the surface of some of these prints, the CPI and PPI, often they're skewed to some of these aberrational issues, like he points to with used cars. Midterm elections data, 2022 midterm elections could introduce volatility. Whether Democrats keep control of both chambers or of Congress, in both scenarios, regardless of who wins, the stock market on average fell between 5 to 7% in the first half of the year. I think we could even see 10%. I think volatility is going to dramatically tick up relative to 2021. And but in the midterm election year, you always see that 5 to 7% in the first half before going on to recover those losses and return 14 to 22% in the second half of the year. I guess as there's more clarity on the outcome, and that's how he gets to 11%. Guaranteed TINA, there is no alternative. That's been a big driving force for stock prices over the past decade. And he's saying his point is that if inflation runs above 3%, most fixed income securities will likely lose money in the short term. But in the intermediate term, fixed income will start to compete with equities, and that's why I think we'll have to be more aggressively on guard in 2024 and slightly on guard in more aggressively on guard in 2023 and definitely on guard with the volatility in 2022. But we welcome volatility because that's our knitting and that's where we make our money. In those 10% market dislocations, there are stocks quality stocks go down 30, 40, 50%, and that's when we start to scoop up. So we have 3 quotes for this week I want to talk about. Buffett's first one, our eyes are placed in front because it's more important to look ahead than to look back. I think that's particularly salient as it relates to China, and we're going to spend a little time on that today. In case you were wondering, Charlie Munger, all intelligent investing is value investing, acquiring more than you're paying for. You must value the business in order to value the stock. And another way to think about it is, if this business were to be taken private, what would be the purchase price? And you just look at comparable sales in the industry and what are the multiples paid for that business? And if they're dramatically under that, so you take enterprise value to EBITDA, and if they're dramatically under that, you want to be a buyer. And if they're dramatically over that, you want to be a seller. But always think in terms of not what is the stock price today. Who cares about the stock price? What are the prospects of the business? What is its historic growth? What is its projected growth? What is a fair multiple that someone would pay to take the company private? And in that context, that's where you can find bargains and that's where you find value. It really doesn't have anything to do with growth versus value. I'll pay 40 times earnings for a company if it's consistently growing earnings at 40% a year and expected to do so for the next 3 to 5 years. That in my view is a value stock. Conversely, I won't pay 8 times earnings for a stock if it's expected to have negative earnings growth for the next 3 years. That's far too expensive. So you have to really take the time and know what you own. And then this Philip Fisher we've covered a couple of times, but this has never been more true than right now. The market is filled with individuals who know the price of everything and the value of nothing. And you see them everywhere, and all you have to do is listen for the first 30 seconds and you know exactly what you're dealing with. And sooner or later, the bill will come due, and we'll see who's swimming naked when the tide goes out. But, keep this in your mind because I think over the next 18 to 24 months, we're going to see this start to play out pretty aggressively. Americans aren't scared of inflation. This is from Business Insider. They already think it has peaked. We agree. We think that probably the big prints of PPI and CPI in December were probably the highest we're going to see in this cycle. As the supply chain starts to ease, and we're probably also going to see that inventory rebuild in 2022 that's going to start to drive growth is going to turn into an inventory glut probably by the second half of next year, and that's the story there. So it's interesting to see because they also refer to something we started talking to you about 3 or 4 weeks ago, which is the 5-year inflation break-evens are now at 269 as of Tuesday's close. That's down from 3.17% in November. That's where they peaked. So that's come off a significant amount, high teen percent. Well, you can't do a percent of a percent, but it's come down materially. And that's basically saying that inflation looking 5 years out has moderated and expectations are at 2.69%, which is above trend, which we expect above trend inflation. We think that'll be good for the economy and good for growth and get people to take action. When people think prices are going to be the same forever, they sit on their hands. But when they know that they're going up, at least moderately, they tend to take action. They tend to take the investment. They tend to build the factory, et cetera, et cetera, et cetera. So that's a positive thing to see. FDA finally authorized the Pfizer antiviral pill to fight COVID. We're seeing the market up this week on that. We think we'll probably see a follow through, even though short term you can get a little overbought. I think on balance, Santa's coming to town, has come to town, will continue through next week, which is that Santa Claus rally period, and probably a bit into January before we get a little bit more cautious. So that's promising. The other thing is there's a lot of talk about overvaluation of U.S. stocks and people starting to look to Europe and Japan, etc. We're more focused on emerging markets in China because we think that's the greatest value. But effectively, what's caused the market to be somewhat overvalued is you've got 5 or 6 stocks that are, 30% of the weight of the S&P 500, and they have high multiples is basically what it comes down to. And I thought this article was interesting. TikTok was the internet's most visited site in 2021, even beating Google. And I would bookmark this article because it goes to show that while these are somewhat monopolies, Google, Facebook, YouTube, etc., nothing is forever. And TikTok came out of nowhere, and in 2 years, it's got most visits ever, and they have left Google and Facebook and all these other behemoths in the dust. So, in that context, you could see those type of stocks start to moderate, and a greater dispersion in the market where the parts of the market. I mean, look, if you look under the surface of the stock market, you've had a handful of stocks that have held up the indices in 2021, and you've had a lot of other sectors just in corrections, bear markets, and collapses underneath the surface. And we think we're going to see a greater recovery in high quality that didn't perform this year, and maybe more of a moderation of these stocks that kind of held up the indices next year. They'll either perform more in line with the S&P or underperform in some cases. But I think there's going to be a great opportunity for stock pickers. And that's always the case in a rising rate environment where you make a ton of money, value cyclicals, small caps outperform. And we're going to look at the quantitative data here in just a minute. This is from Bloomberg, where to find cheaper alternatives to expensive stocks. And what this author, Nir Kaisar from Bloomberg, is referring to. He goes through the PE ratios, S&P 500, and then if you just take one step down, small cap index is trading at so the S&P 500 is at 21.9 times, S&P small cap is at 16.4, the value index is at 17.8. But then if you go to Europe, it's at 15.2. If you go to emerging markets, which is basically 40% China, it's at 12.7 times, which is the low end of its 5-year range. If you go to European value, it's at 10.7 times earnings. And if you go, and you got to put that in the context of look how cheap money is. So these multiples are staggering. And finally, if you go into emerging markets value, it's at 8.9 times earnings. So for everyone saying the market's in a bubble, there's half of the world that's in a reverse bubble, a cheap value of, well, whatever. You can find tremendous value. And that's why we're focused on emerging markets going into 2022, particularly with a heavyweight on China when no one wants it. Buy when there's blood in the streets, even when it's a little bit of your own. It's certainly been the case, but we've just been harvesting some winners, putting some more money to work in what we think is going to be a home run in 2022. We put a very decent sized options position out 6 months and beyond for Alibaba this week, pretty aggressively. And what's interesting is where you start and where you finish up. I mean, this thing now, as it moves up, I think, and we'll see, I think this is going to turn out to be one of the best trades of my career when this trade plays out over the next 12 to 18 months, despite the bumpy start. But this points to it. This table right here that the author laid out. This is where we're fishing, here and here. 12.7 times, 8.9 times. That's where we're going to make our money in 2022. It doesn't preclude us from having, obviously, all the other stuff. It's that, you have to manage sizing and everything else, and we'll have all of this stuff exposure to the rest of the stuff, but we want to get some good weights here where we can get a lot value for the dollar. Boeing got an order of 19 of its 767 freighters this week. That stock is trending up the last few days, so that's positive to see. Some more good news out of China. Chinese financial regulators instruct banks to step up bond issuances and loans to boost M&A activity in the property sector. As we said, we're going to see a lot of stimulus and monetary easing in China. While the rest of the world is tightening, China is going to be easing in 2022, and that's why we're getting aggressively positioned there. China's central bank cuts a benchmark rate for the first time since the pandemic. We signaled this was coming. Everyone said no way. Well, there you have it. In the last 2 weeks, not only have you had the reserve requirement ratio cut by 50 bips, that's going to come down another 100 bips probably in the next 3 months. You've also had China lower the 1-year loan prime rate, albeit it was only 5 bips. It's the start of the trend into easing, and they're going to be more and more aggressive with this. And so everything is checking off on the boxes. And then here, China's securities regulator ready to communicate with U.S. counterparts on audit oversight cooperation. So the CSRC, which is the China Securities Regulatory Commission, said currently dialogues on audit oversight cooperation between the Chinese and U.S. regulators are ongoing and have yielded positive progress. So furthermore, with full respect for international norms as well as laws of both jurisdictions and in the spirit of mutual respect and trust building, we believe the regulators will be able to find a solution to satisfy regulatory mandates of both sides, said the CSRC. So ultimately, delisting, as I've said, is not really a risk. I mean, VIEs have been around for 20 years. But there was no downside to switch out the shares for Hong Kong, which we did. Our derivative positions are still all on the U.S. ADS, the BABA, and our stock holdings are in the Hong Kong ADR. The key reason we want to see the U.S. shares stay in place is because when you have U.S. capital, it commands a higher multiple when it's listed on the U.S. exchanges. Number one, there's greater liquidity, which is fine. It doesn't matter. Institutions can buy the Hong Kong shares just as well as they can buy the U.S. shares. But the U.S. multiple relative to the Hong Kong multiple historically has been such a wide spread that if BABA can stay on the U.S. exchange, it will make the shares more valuable, and that just pulls up both shares. I mean, both the Hong Kong and the U.S. trade 8 for 1 exactly at the same valuation, but if we stay on the U.S. exchange, that valuation is going to be much higher for both of them than if it only was traded on the Hong Kong exchange and traded more in line with the Hang Seng historic multiple. So by staying on the U.S., both get the U.S. multiple. If the U.S. is delisted, then you might have potentially a lower multiple in the Hang Seng, but probably not, because you'll see all the institutional money go there, and there's only so much supply of Alibaba ownership, and it would probably command something in line with the growth rate, which slowed during the regulatory year, but is going to ramp back up. And you saw it in the Investor Day last weekend, talking about the huge growth outside of China, and talking about hitting the rural areas within China successfully, and their young demographic is growing and doing an average merchandise value of 1.4 times the rest of their clients, and the cloud services. So that's the good news. The bad news was the Alibaba was down a little bit in the last 2 days, because the China's industry ministry pulls support from Alibaba Cloud for not reporting a flaw to the government first. So they had some bug, LOG4J, I think it's worldwide. It's not exclusive to Alibaba. But they notified the vendors before notifying the government, and everyone's like, oh my God, the government's dropping Alibaba Cloud. And if you actually just read a little bit more, What in fact happened was the Ministry of Information and Industry, Ministry of Industry and Information Technology is suspending work with Alibaba Cloud as a cybersecurity threat intelligence partner for 6 months because the company did not immediately report a severe bug in the widely used software, blah, blah, blah. So it's not in perpetuity. It's saying you didn't have the structures in place to immediately notify us before the vendor. You need to show us over the next 6 months that you're going to do that, etc. So they will do that. They were out today with their apology and their process to do it, and that will get resolved. And it's not a huge part of their business or anything else. It was just the headline that got the stock. But again, if you remember, we are not expecting any miracles before year end. As a matter of fact, let me see if I can pull this up. Just really quickly before I change the charts here. Here's Cigna. Cigna's one of our favorites. We think this is going to work its way back up to new highs, and it's been taking off in the last 3 weeks, up to 225 now. I think 226 today from 190. We think this has a lot more to go, and we're excited to see that one starting to work. Let's just pull up the 2018.
My understanding
Alibaba,
is
and you
that
can
the
see
Chinese government,
that when people
not
don't
unlike
own
the
it,
Russian government,
they
is
tend
not
to not
doing
want
this
to own it
themselves,
until the
but are
calendar
protecting those
changes.
who are doing it, and maybe
Here we
even
go.
accommodating them being able to do it.
All right, so you've got, so this was how Alibaba bottomed. This is basically, it looks very similar to how it's been behaving this year, and then it puts in a new low, and then it rallies up, which it did, and then this is what happens. You can see, which is pretty similar. We got a little spike up, and now a couple days down, and that coincides with January 3rd, 2019. So you had all this weakness in the year end, and then boom, it just rocketed right out, and moving about 60 points within a matter of 6 weeks right after. So we'll see.
The indictment alleges that
History
3 of the
doesn't
4
repeat,
defendants
but it does have a tendency
were
to
intelligence
rhyme.
officers
So we'll
with
see how
China's
that plays
Ministry
out.
of
But
State
let's get to the
Security,
article of the
or
week here.
MSS.
The Grinch
They
is
implemented
dead,
the alleged
stock
cyber
market
attacks
and sentiment
through
results
front companies
after the Fed
in order to
induced
conceal
debacle
the
in
government's
December
role
2018,
in the illicit
which caused
scheme.
the S&P 500 to cascade down over
The actions of
16%
the
in
Chinese
3
government
weeks,
will
making it
not
the
be
worst
condoned
December
or
since the
ignored
Great
by the
Depression.
U.S.
They took the
government.
Grinch out back behind
And
the
we
barn
believe
and shot
all
him.
nations who share
There will
this
be no
same
Grinch
view
this year, and
should
Santa
send a
Claus
clear
is coming
message
town,
to
and
China.
We're already seeing that. So, Mariah Carey's 20-year-old hit, All I Want for Christmas. I want 5 things for Christmas. First off, to see an Omicron peak in the U.S. like we saw in South Africa, which is just completely rolled over. It's down. Cases are down. Peaked on December 12th. Cases are down 77.5% in 8 days since. It's probably more now. I think 2 more days since I did the TV spot. So probably down over 80%. Next, we want the steeper yield curve. This is the core, what keeps me up at night? This is what keeps me up at night. Because once this thing inverts, you get a recession 6 to 18 months out. There's still chance for them to pull this up. In theory, what they're doing right now, which is coming out of the long end of the curve with taper aggressively, we're starting to see the 10-year yield trickle up here this week, up about 9 basis points to about 150 bips, up from 141 bips. So that should start to re-steepen the curve, but we also have the foreign demand that we talked about last week because their yields are so low. Even at 150, it's a deal for them after hedging out currency. But I think we're early enough in the cycle that we could see something that looks like this is similar to this, and then we get a re-steepening before finally rolling over. That said, if we're already rolling over, you can see there's plenty of time before we get the big crash, before the inversion, and even after the inversion, you get a little time. Even here, as we were going towards flattening, banks and the S&P 500 climbed for, two plus more years before getting the crash. So, but ideally, this should be a longer cycle with the millennials and the demography that we've discussed over the last year. But I would like to see this start to re-steepen in coming weeks after the new year. And if so, this is going to be a much longer cycle than everyone expects. Third thing I want for Christmas is a stronger bid in value. It's interesting. U.S. tech stocks we talked about earlier in the call. This looks very similar to 2000. I'm not calling for some monster tech wreck, but I do think there's going to be a rotation where they'll perform less well than some of the groups that have been left behind. And that's historically the case with a steepening yield curve and rising rates. You saw in 2000 to 2002, the guys buying value in 99 looked like idiots. By 2001, they were geniuses because they didn't get the upside that everyone got in tech, but they also didn't get the downside. And many of them had 20 to 30% plus years from 2000 to 2001 to 2002 to 2003, even as the S&P was rolling over, the NASDAQ down 80, 90%. And but if you pick value smart, energy did very well during that period. Some banks, some cyclicals, industrials, etc. If you picked well, you dramatically outperformed while everyone else was losing money. And I think we're going to see a similar situation in coming years. And you're seeing a similar setup in the value to growth relationship and also the kind of aggressive valuations of some pockets of tech. The fourth thing I want for Christmas is China to awaken from its slumber. As it has in the 12 months preceding every National Party Congress meeting. The next National Party Congress is November 2022. So we're within that 12-month period. The average return for the MSCI China during that period in the ramp-up is about 30 to 31%. And then we'll probably exit stage left after that. As you can see, the returns are less favorable. So this is a regular pattern that they do every 5 years into the National Party Congress, and in general with their economy, they show their power, they overregulate, the economy slows down, then they have to ease and stimulate, the economy rips higher, rinse and repeat, the economy rips higher, a lot of people get rich, they crack down, common prosperity, et cetera, and then they realize, oh, no, we can't crush capitalism because then people don't have jobs and then they'll riot. So they then stimulate and rinse and repeat. And then the fifth thing I want for Christmas, even more equity to take advantage of the abundant opportunity ahead of us. When you get the fat pitch down the middle of the plate, you can never have enough personal and client capital to put to work and seize the opportunity. No matter how big you grow over the years, when that right opportunity comes, more is better. I believe the value in very selective, high-quality, large-cap China tech right now is the fat pitch down the middle of the plate and can turn 2022 into a home run. If done in prudent size, we are well prepared, and we are really well prepared right now through a combination of stock and some derivatives that we put on this week. So we're excited about our actual and notional value exposure, but done in a responsible way. We've talked many times in the past month about the fund in London who put 80% of their portfolio in Alibaba of a $5 billion portfolio. These are two ex-Goldman guys, and I think they're going to be right, and they're going to make an insane amount of money. Their idea is, I don't know if they are, because their clients may not be around long enough for them to realize that outcome. So you never want to put that type of concentration. We've always said never put it in a concentration where they could carry you out on a stretcher, or the rest of the portfolio can't overcompensate until your thesis plays out. And max highest conviction of equity for high conviction is 10 to 15 to 20%. The highest conviction trade will ever do is 20%, and we'll have a very diverse rest of the portfolio. So if we're wrong, we can still outperform over the 1 to 3 year time horizon. But I'm very, very sanguine about 2022 and how we're positioned for that. And, again, it's knowing the value of what you own, not the price, because when that value is realized, that's where you make your money. So it'll be interesting to see. I mean, I had a funny thought this week. I said, what would happen? Munger's doubled down on his Alibaba position. We'll probably see for Q4 that he bought more. But I wonder what would happen to the price of Alibaba stock if we found out in Berkshire's quarterly filing in Q1 of 2022 that Buffett bought it. Munger talked Buffett into buying it for Berkshire because it was so cheap. And by the way, Munger has talked Buffett into buying Chinese stocks before. They bought BYD, the battery maker, 10 years ago. It did nothing, and now it's one of the best investments they've ever had. I think it's 900% returns, but it all happened in like the last couple of years. So it's not out of the question. I'm not sure if Buffett would want to do it in this political climate, because candidly, he's too old and too rich to deal with nasty headlines. But I do think that there's a huge case to be made for it. And if Munger were successful again, what would happen? Because everyone knows it's trading dramatically below intrinsic value, and the risks are all out there and they're all known. My guess is if you saw a filing like that, you'd see it trade up to 200 within a quarter, and then it would probably start to climb up from there closer to intrinsic value, another 30% over the next 4 or 5 months. Not to say that's going to happen, but it's to say if you got his blessing, people would then believe in the intrinsic value, even though inherently everyone knows the intrinsic value is there. It would just be like the magic pixie dust that makes it realized versus unrealized gains, so to speak. So think in terms of that. Would you buy it if Buffett bought it? And I think more of you would buy it knowing that Buffett owned it at $230 than you would buy it just from your own analytical work at $120 or $125. And if that's the case, you have to ask yourself, what about your analytical process is lacking that you're willing to leave $100 move on the table waiting for someone else to confirm it for you that it makes sense. And I think that's just generally how the market works. Everyone wanted Peloton at $180 or whatever it traded up to. No one wants it at $38. Everyone wanted ARK. It's interesting because TikTok's the most viewed thing. I scroll through TikTok, and we post our TV interviews on TikTok. And, you would see this guy, he walks around in Palm Beach and he interviews wealthy guys and gals in nice cars. And he says, what do you do for a living? And one guy, it was literally the top of them. It must've been February, the top of ARK. He goes, oh, just buy ARK. So he might've traded in that Ferrari for, a Porsche Boxster or something like that. But, everyone wants it when everyone's in agreement, and that's when you want to be laying it off. When everyone wants it, help them out, and do your own work, do the due diligence. So the Grinch is dead. On Tuesday, I was on Fox Business, the Clayman Countdown with Liz Clayman. Thanks to Liz and Ellie for having me on. Below are the show notes for the segment. We could not get to most of this because President Biden's speech took the first 20 minutes of the show, and they were short on time. So I made the same case. The Grinch is dead. Santa's coming to town. I also laid this out before anyone else was talking about it, by the way. The fact that everyone started talking about it yesterday. The case count in South Africa has rolled over 70. It peaked at 37,875, all-time high. And it was at, I think, 8,100 on the day I went on TV. Dropping 77.53. And I said that I think market participants, particularly institutions that get this data, or pay attention to this data rather, because the data is ubiquitous, we're paying attention to that and hopeful that this would be the trajectory in markets all around the world, and I think it will be. The other great thing about it, I think Marko Kolanovic, who we covered last week, is going to be correct that this variant should probably be called Omega instead of Omicron. Omega is the last letter in the Greek alphabet because with 32 mutations and the weakening, everyone I know who's gotten it already, they're sick for 2 days, they get a fever, and then boom, by day 3 they feel great. And then furthermore, those people who are boosted have their third Pfizer dosage. It's 90. It's high percentage of people fully asymptomatic. I almost think if people didn't test, no one would know that we wouldn't even have a spike because people simply aren't feeling it, which is good. But that's not to discount it's serious. Take it serious if you have all comorbidities and that type of stuff. Be careful in the holidays, etc. But we have so many more tools, and to Biden's credit, he's absolutely right. This is not March 2020. We have the vaccines. We have 200 million people, I think, fully vaccinated. We have now the treatments. The Pfizer pill that I've been talking about for the last few weeks was approved yesterday. That's going to be a huge deal. And that's that. So the second thing I mentioned to Liz, earnings despite Omicron and the GDP downgrade by Goldman Sachs. Goldman Sachs downgraded GDP in the first quarter because of the Build Back Better fell through with Joe Manchin. Biden alluded to the fact that will probably be rejuvenated in January. It'll be a watered down bill, which is a positive thing for inflation. If anything at all passes, if nothing passes, then no changes to the tax. You still have the Trump tax situation in place, which is very positive for the economy. And there would be no negotiation on drug pricing. So you're seeing the drug stocks move. So we'll see if anything gets done. But despite that downgrade by Goldman, earnings estimates continue to creep up. As I said, 223.48, up 9% for 2022. This is a tailwind for the market, gaining high single digits to low double digits in 2022. The headwinds, second year of a presidential cycle tends to be the weakest of the four. The market will start to discount the removal of liquidity following taper, which ends in March, by the way. And we should see a much bumpier ride in 2022 than we did in 2021. Okay. Average returns for the year, high single digits, low double digits, but expect 10% plus pullbacks along the way. I think we're going to start to see that in 2022. You can see here the table. This is from Ryan Dietrich of the presidential cycle. On average, the second year is the weakest for equity returns. And then under new presidents, it tends to be even weaker. So keep an eye on that. And then finally, don't fear the reaper. Everyone's afraid of interest rate hike takeoffs, which now people are thinking can happen much earlier than anticipated. A couple months ago, people were saying 1 rate hike in 2022. Now they're saying 3. But the S&P gains on average 7.7% in the 12 months following the first rate hike. This is from Deutsche Bank via Ann Straders over at Fortune. Analysts at Deutsche Bank identified 13 separate hiking cycles since 1955, which lasted an average under 2 years. And according to their research, which examined the average price performance of the S&P 500 on a daily basis, there tends to be solid growth in the first year of the hiking cycle with an average return of 7.7% after 365 days. However, after the initial peak on day 253, after the tightening cycle, it's not until day 452 that this level is exceeded again. So after that first year, they're anticipating 2024, or it could be as early as 2023, that things are going to go flat for a while. Day 452 that this level is exceeded again. And on even on day 712, it's still trading beneath its level on day 253, they wrote in Deutsche Bank's chart below. So this is the chart here. It kind of shows the trajectory after rate hikes. And you can see going into it, and then the first 250 some odd days, and then you go flat here on average before picking back up. And then I put out the Blue Oyster Cult, Don't Fear the Reaper, Don't Fear the Rate Hikes, both in the original version, which is fantastic, and then in the more cowbell version with Will Ferrell on Saturday Night Live, one of my favorite skits from Saturday Night Live, so you may want to click on that and have a few smiles here in the holidays. And then the last thing I covered with Liz was the 10-year yield rising favors value cyclical small caps, a big opportunity in industrial sector in 2022. Industrial earnings growth will be 36% relative to the S&P 500 at 9%. This is not priced in our view. Opportunities in subsectors like travel, we like Southwest, bet on recovery, pent-up travel demand. TSA pass-through numbers were greater than 80% of 2019 level this week, over 2 million passengers a day, despite the Omicron hysteria. Defense, Raytheon is trading at 16.5 times next year's earnings compared to its 18 times historic, 2.5% dividend yield. Supply chain and aerospace will recover in 2022. And finally, GE, the sum of the parts is greater than the whole in the breakup and spin out. Larry Culp is one of the best CEOs in the country, came from Danaher, which is one of the greatest compounders of all time. So, as you can see in the table below, which sectors outperformed in the 12 months after the first rate hike. And the answer is small caps, value, and energy are at the top of this list. Value dramatically outperforms growth 12 months out. And you can see here that the median performance for value 12 months out is 13.6%. The median performance for growth 12 months after the first hike is 4.9%. And you see energy up 14.9%. Small caps up 15.8%. So these are the areas that you want to be paying attention to. However, that's within 12 months after the first hike. We have not had the first hike yet. And we'll talk about that may come in the spring, and we'll talk about some of the odds in just a minute. But we've been comparing, by the way, this table is from Nomura via Zero Hedge, so give credit to them. We've been comparing 2022 to 2014 and 2018, i.e. higher volatility years after low volatility years of 2013 and 2017. We're giving greater weight to 2014 because it was also a taper year. So this table here is from Putnam and Bloomberg. This was the S&P sector performance during taper. Now, keep in mind, our taper is only going to be, it already started in November. It's going to end in March. And look at what outperforms. One of the biggest outperformers is healthcare. And that's why we like Cigna so much. And that's why we're seeing Cigna take off and some of the drug stocks that we've talked about in recent weeks. But this game ends in March. So you already mostly want to have had your exposure. There might be some opportunity in some laggard pharmaceutical stocks, particularly if that Build Back Better program gets flushed. Then the pharma stocks are really going to rip high. The ones that have been smoked, like Bristol Myers, AstraZeneca, Novartis, etc. Those ilk are going to move. So while small caps, energy, and value outperform in the 12 months following the first rate hike, which may come this spring, for the November through March, the taper period, we may see some continued legs in healthcare, which we covered in the table above. Here are the rate hike odds for May 4th, 2022 FOMC meeting. They continue to creep up. So right now, they have a 25 to 50 basis point target at 49.4% probability on the May 4th Fed meeting. That's climbed up in the last month from 39.2% probability to 49.4% probability. So people are really thinking, if not March, by the May meeting, you'll see that first rate hike has already been in place. And that's when you shift from this taper playbook to this post-taper playbook, rate hike playbook, which favors small caps, energy, value, etc., cyclicals. So tailwinds for Santa. While we've had a nice move in the past 2 sessions and may breathe for a session or two, here are a few indicators that suggest Santa has some gas in the tank for the final week heading into January. Here's the 10-day moving average of the put-call ratio starting to roll over. That was peak fear and pessimism. That always aligns with that type is those bottoms, which we just got out of, and that will roll over. Here's the NASDAQ 1% exponential moving average of the advanced decline ratio. When it tends to bottom at these levels, you get a bounce, 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 bounce. So we're closer to the bottom than we are to the top. Same thing with the NASDAQ up, down, on balance volume oscillator. Again, it's getting to those levels where you get these big bounces. Okay, and then finally, 2 more. The PMO by all. We like this one. It's down back at the 0 level. I think it ticked up a few points, but at 100 is where we start to look to peel off. Down here is where we're buyers. Same with the bullish percent S&P 500. Again, it's at those levels where you get these bounces. This is the S&P 500 below, and you can just line it up and see. Okay, now China. Bull in a China shop. So last week we showed you what happened each time the Hang Seng Index traded below book value as it is now. This was the chart. We'll get to that in a second. This week, we have a few more charts to give you an idea of where we may be in the cycle. So this is the Hang Seng Index. It's trading at its lowest relative to world peers since 1998. So this is the Hang Seng Index relative to the MSCI All World Index. Okay, and this is the ratio. The last time it was down here was 1998. And these are the type of extremes that I like to play. Now, the last time the rubber band got stretched this far, Hang Seng relative to the world, it rebounded 156% over the next 12 months. So, over the next 17 months. Now, this is not a stock moving 156% in 17 months. This is the whole Hang Seng Index moving 156% over the next 17 months. This means many of the individual stocks were up 200, 250. I'll bet you could even find a bunch above 300% or more over that same 17-month period. So this is where that ratio got to this level. This is what happened to the index, up 156% over the next 17 months. Now, here's the magnitude of the rallies in the Hang Seng Index from last week's price to book chart. So the Hang Seng Index has only traded below book 1, this is close to it, 2, 3, 4. This is the 5th time in the last 30 years, give or take, or 26 years. And here's what happened after it traded down to this level. We're at the 5th time now. It did it 4 other times in the last 30 years. In 1998, when it traded below book, it went up 156% in the next 17 months. In 2018, when it traded down to book, it went up 110.77% in the next 21 months. In 2016, when it traded down to book, it went up 82.52% in the next 23 months. And in 2020, when it traded down to book, it rallied 35.99% in 11 months. That's when BABA traded up to $320 or wherever it peaked out at. And now we're back down to book, and I think we're going to see a monster move here as well. So this helps you visualize 156% rally every time it got down to this level, 110% rally, 88% rally, 35.11, 35.99. And even if we saw what Goldman expects, the average 31% into the China National Congress, you're going to see tons of stocks up 100 and 150%, which would be phenomenal. As a point of reference, during the 2 periods that the Hang Seng reverted from depressed levels while Alibaba was a public company, here's what happened to Alibaba. So the Hang Seng recovered 156%. Alibaba recovered 234%. Excuse me. This is 2016%. 2016. So the 2016 rally, the Hang Seng recovered 82%, and Alibaba in 2016 recovered 234%. So the index did 82% after it traded down to book. Alibaba did 234% over that same period. And then in 2020, the index recovered 35.9% after trading down to book, and Alibaba recovered 70%. So in both cases, Alibaba doubled the returns of the Hang Seng after it traded down to book and recovered. So we're expecting more of that. No guarantees of future results, but it's a pretty long track record of the cycle. So here's another chart this week that mimics Goldman Sachs report we covered 2 weeks ago on our podcast VideoCast, as well as the normal 3 to 5 year rhythm we've been emphasizing in the last month or so. First, you get the regulatory crackdown, then you get regulatory crackdown, then you get the slowdown, then you get the stimulus and easing, and then you get the huge rally, rinse and repeat, rinse and repeat, rinse and repeat. Keeps happening over and over and over. Now, onto the shorter term view for the general market. This week's AAII sentiment survey result, the bullish percent ticked up to 29.6% this week from 25.2% last week. Retail optimism is slowly rebuilding. So you can see it here in the chart. The fear and greed was still at 37, up from 34 last week. This is still favors being a buyer versus being a seller, as you can see here in the longer term chart. And the National Association of Active Investment Managers, let's see where this is at. Because it was at 52 last night, which means they've got to chase into year end. Let's see if they've started, because they print on Thursday afternoon. It's at 67.02, so they still got a long way to go. If Santa comes to town, they're going to be chasing the reindeers like it's going out of style to catch up. Our outlook for 2022 remains intact. High single-digit to low double-digit returns for the S&P and much more volatility as participants sniff out the liquidity withdrawal by Q2 of next year. We will continue to be focused on buying those areas of high quality that are on sale and trading at reasonable valuations. We'll go into more on this week's podcast video. We just did that. See you then. So that's the story there. And then let's just go through some of the economic data like we close out with each week. And we'll get you on your way to have a happy holidays, Merry Christmas, and we'll see you before the new year next week. So let's go here and economic calendar. Okay, this week. And US. Okay, so what we know is, US leading index on Monday came in a little better than expected. That's good to see. API crude, that's the Tuesday night, had a draw of 3.7 relative to 2.6. Oil's trading up on that, and also the EIA. Core CPE came in a little hotter than expected on Wednesday. Consumer confidence came in better than expected. The Consumer Conference Board came in at 115.8 versus 110.8. Shows the strength. Even with Omicron scaring for the last 3 weeks, the consumer is in good shape. Inventory draw was the EIA report. Negative 4.7 million barrels versus negative 2.7, so that's positive for energy and oil. We saw that. Continuing claims was higher than expected. I don't like to see that. That was this morning. Core CPE year on year was hotter than expected. And durable goods orders came in much better than expected at 2.5% versus 1.6%. Goods orders non-defense ex-air were lower than expected, and initial jobless claims were in line with expectations. Consumer expectations better than expected. Consumer sentiment slightly better than expected, 70.6 versus 70.4. New home sales were a little lighter than expected. inflation expectations were 4.8 versus 4.9%. So those expectations are coming down. That's actually a good thing, which we covered with the 5-year break-evens. And that's basically all the core data for this week. So with that said, I want to thank you for listening in. Happy holidays. We'll be back next week, same time, same place. In the meantime, make it a great one.